let's talk about building wealth. We spend so much time and energy trying to pick the absolute best stocks or the perfect funds. And yeah, that's important. But there's this other huge lever you can pull, one you have almost total control over that can literally change your financial future. And that lever is taxes. So today, we're going to build a blueprint for tax-efficient investing. And I don't want you to think of this as a chore. Think of it as one of the most powerful tools you have to keep more of your own money. I love this quote because it just nails the concept perfectly. Your investment returns, that's the high-octane fuel for your journey to financial independence. But taxes are like this slow, steady, silent leak in the gas tank. You might not even notice it day to day, but over decades, that leak can leave you stranded miles from your destination. This whole explainer is about one thing and one thing only, patching that hole so you can go further, faster. So here's our game plan. First, we're going to get a good look at that leaky gas tank to really understand the damage it can do. Then, and this is the big one, we'll talk about the cornerstone of this whole strategy, asset location. After that, we get super practical. We'll talk about filling the right buckets with the right stuff, and I'll give you a clear, step-by-step plan for where your next investment dollars should go. Then we'll cover some cool, advanced tools for your taxable accounts. And finally, we'll tie it all together with a real-world example so you can see exactly how this works. All right, let's dive in. The cost of investing isn't just the expense ratio on your mutual fund. No, there's this hidden cost, this drag on your portfolio. Every time a company pays you a dividend or you sell a stock for a profit in your regular brokerage account, guess who shows up with their handout? The tax man. It might seem small each time, but over 30 or 40 years of compounding, this silent erosion can cost you a fortune. Now, I want to be crystal clear about something. Tax-efficient investing is not some shady, offshore tax evasion scheme. Not at all. It is the 100% legal, smart, and strategic practice of arranging your investments to pay the least amount of tax required by law. Look, you can't control what the market does next week, but you can control how you set up your accounts to minimize that tax drag. It's truly one of the only free lunches in the world of finance. Okay, everybody, lean in for this one. Seriously, if you walk away with only one concept from our entire time together, I want it to be this. We're talking about asset location. It sounds a lot like its famous cousin, asset allocation, but they are totally different. And from a tax point of view, well, asset location might just be the most important decision you make. It's the simple idea that where you own your investments can be even more important than what you own. So let's just hammer this distinction home because it's a super common point of confusion. Asset allocation is the what? It's your recipe, right? Your mix of stocks, bonds, real estate, maybe 70% stocks, 30% bonds. That's allocation. Asset location is the where. It's deciding which kitchen cupboard, which account you're going to store those ingredients in. Getting the where right is the absolute foundation of this whole thing. To understand location, you got to know the landscape. And for pretty much every investor, you've got these three main buckets to put your money in. First up is the tax-deferred bucket. Think of your traditional 401k or IRA. Here, you got a tax break today. The money grows tax-free, but you pay income taxes on it when you pull it out in retirement. Then you've got the golden goose, the tax-free bucket. This is your Roth IRA, Roth 401k, or an HSA. You pay the taxes up front, but then it's magic. The growth and the withdrawals are 100% tax-free. Forever. It's incredible. And finally, you have the taxable bucket, just a standard brokerage account. No special treatment here. You pay taxes on gains and dividends pretty much as they happen. Our mission is to use these three buckets like a chess master. So, we have our buckets. Now for the fun part, what exactly do we put inside them? The guiding principle here is beautifully simple. You want to hide your most tax-inefficient investments in your tax-sheltered accounts and let your most tax-efficient investments live out in the open in your taxable account. Let's start with your VIP accounts, your sheltered accounts, the 401ks, IRAs, and HSAs. Think of these as a tax sanctuary. You have limited space in here, so you want to use that precious real estate to protect the investments that would otherwise get hammered by taxes every single year. These are your tax-inefficient assets. And here's the lineup of usual suspects. So why are these so bad from a tax perspective? Well, take something like a corporate bond fund. The interest it kicks off is taxed as ordinary income, which is your highest possible tax rate. Same story for most REIT dividends. And don't get me started on high turnover funds. They're constantly buying and selling, creating a constant stream of capital gains that get passed right on to you, even if you never sold a single share yourself. It's a mess. By sticking these inside a 401k or an IRA, all that annual tax headache, poof, it just vanishes. Okay, let's flip the script. What about that taxable brokerage account, the one that gets no special protection from the IRS? This is where we want to put our varsity team of tax-efficient investments. These are the assets that naturally don't create a big tax bill year after year. These are the all-stars for your taxable account. Broad market ETFs, for example, are usually built for very low turnover, so they don't spit out a lot of capital gains. Individual stocks are great too, as long as you hold them for more than a year. Once you cross that 366-day mark, any profit gets taxed at the much lower long-term capital gains rate. And municipal bonds? Well, they're the superstars. Their interest is often totally free from federal income tax. They just don't leak taxes, which makes them absolutely perfect for this bucket. Okay, I know that was a lot of theory, but theory is useless if you can't put it into practice. So let's get down to brass tacks. It's payday. You've got money to invest. What is the exact order of operations? Where does that very next dollar go to give you the biggest tax advantage? Let's build that plan right now. But wait, before we even look at the list, we have to talk about this. The absolute, undisputed, #1, non-negotiable first step. If your employer offers a 401k match, you contribute enough to get every single penny of that match. This is not investment advice, this is just math. It is a guaranteed, instant 100% return on your money. You will not find a better deal anywhere on planet Earth. Not taking it is literally lighting free money on fire. Do this first. Always. Okay, match secured. Now here's the priority list, the waterfall. Step 2. Max out a Roth IRA if you're eligible. That tax-free growth in retirement is just too powerful to ignore. Step 3, if you have a high-deductible health plan, you've got access to a secret weapon, the Health Savings Account, or HSA. This thing is a triple tax advantage superhero. Money goes in tax-free, it grows tax-free, and it comes out tax-free for medical costs. It's the best retirement account, period. Max it out. Step 4, now circle back to your 401k and keep contributing until you hit the annual IRS limit. And only then, after all those other accounts are full to the brim, do you move to step 5, putting money into a regular taxable brokerage account. That's the plan. So the taxable account might be last on our funding priority list, but that doesn't mean we just forget about it. In fact, because it's our least tax-efficient bucket, it's where we can use some really cool, more advanced strategies to fine-tune our portfolio and claw back some of those tax dollars. Let's look at a few power tools. The biggest and baddest tool in the shed is called tax loss harvesting. Now, the name sounds like a downer, but it's actually about turning market lemons into lemonade. Here's how it works. Say an investment you own is down. You sell it, which harvests or realizes that loss for tax purposes. Then you can use that loss to wipe out capital gains you might have from selling other things that went up. It's like they cancel each other out. And if you have more losses than gains, you can use up to $3,000 of that excess to directly lower your ordinary income, like your salary. It's a brilliant way to get a tax break when the market isn't cooperating. It's an amazing strategy, but there's a catch. There's always a catch, isn't there? When you're tax loss harvesting, there is one critical, ironclad rule from the IRS that you absolutely, positively cannot break. And that rule is called the wash sale rule. It basically says you can't cheat. The IRS will disallow your beautiful tax loss if you sell a security and then buy back that same one or something substantially identical within a 30-day window. They don't want you just selling and immediately rebuying to create a phony loss. So the smart move, you can sell your S&P 500 ETF to harvest a loss and then immediately buy, say, a total stock market ETF. You stay invested, you maintain your exposure to the market, but you still get to book that valuable tax loss. It's playing by the rules, but playing it smart. Okay, we have covered a ton of ground here. The leaky gas tank, the 3 buckets, what goes in them, the priority plan, and even tax loss harvesting. It's a lot, I know. So let's pull all these different threads together and see how they work in the real world with a simple case study. This is where it all clicks. So let's meet Emily. She's 35, she's a high earner, and she lives in a high-tax state, California. She's already doing all the right things. She's maxing out her 401k and her Roth IRA. Good for her. Now she's got an extra $50,000 to invest in a new taxable account. Her overall portfolio goal is a 70-30 stock-to-bond mix. Now here's the key. That 30% in bonds, those are tax inefficient, remember? She's almost certainly holding all of those inside her 401k already. So this new $50K, it needs to be filled with the most tax-efficient stock assets she can find. So what's the move? Well, here's a great strategy. She put 60% into a broad U.S. stock ETF and 30% into an international stock ETF. Both are great, low-cost, tax-efficient choices. But look at that last little 10% slice. That's the pro move right there. A California municipal bond fund. Why? Because she's a high earner in California, the interest from those bonds is completely free from both federal and state income tax. That's a huge win. And that's how it all comes together. See? Emily is using her taxable account for exactly what it's best for, holding highly tax-efficient assets that work together with what she holds in her retirement accounts. She isn't just randomly buying investments. She is building a cohesive, tax-optimized machine, and that machine is designed for one purpose: to maximize what she actually gets to keep in the long run. So, let's end on this question, because this isn't just about learning some theory, it's about taking action. You don't have to go home and sell your entire portfolio tomorrow. This is a marathon, not a sprint. But what is one small thing, one conscious change you can make today after hearing all this? Maybe it's just logging in to see if you have a clunky, high-turnover mutual fund sitting in your taxable account. Maybe it's just making a mental note to hold your next investment for at least a year and a day. That one small, good decision is the first step. And it's those small steps taken consistently that build a truly wealthy future.